Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. I'm Ethan.
And I'm Brooke. We're here bright and early on Tuesday, December 23rd, 2025, to sift through the market chatter and AI-generated insights we gathered yesterday, Monday, December 22nd.
Well, it was certainly a busy day for our algorithms, wasn't it, Brooke? We saw a lot of activity, flagging nearly 30 different stocks across the board. The sentiment was really a mixed bag, from pure optimism to some serious cautionary tales.
Absolutely, Ethan. We had a significant number of posts to analyze, reflecting a highly engaged and, in some cases, highly speculative market. It's always fascinating to see where the community's conviction truly lies, especially when it bumps up against the cold, hard numbers. Today, we've got some interesting contrasts to discuss.
All right, let's jump right in. First up today, we have Rigetti Computing Inc., RGTI. You know, this quantum computing play keeps popping up. Users are watching it, and there's chatter about a triple support area and its potential to soar over 90% in 2026. Billionaire investors are even reportedly buying in. That's the kind of future-forward growth story I love to see.
Ethan, while the buzz around quantum computing is undeniable, our KPIs for RGTI are screaming caution. We're talking negative revenue growth, deeply negative net profit margins, and an operating margin that's firmly in the red. Their debt-to-equity ratio is over 2.0, and the price-to-book is an astronomical 23.5. This isn't just speculative. It's a company with severe fundamental weaknesses right now. Plus, insiders have been net sellers, offloading over 740,000 shares in the last 6 months. This stock has consistently been a stay away in our past ratings.
Okay, that insider selling definitely gives me pause. So for Rigetti Computing, RGTI, our market commentary suggests stay away.
Next, we're looking at Oracle Corporation, or RCL. There's been some discussion, mostly around Larry Ellison's personal financial backing of the Paramount bid for Warner Brothers Discovery.
Now, some of the news actually highlights Oracle's stock being up, their new TikTok deal, and their relevance in the AI boom. Jim Cramer even gave them a positive endorsement. Plus, our insider data actually refutes some user claims. Insiders have been net buyers of millions of shares, which suggests confidence.
While insider buying is usually a good sign, Ethan, we can't ignore the incredibly high debt-to-equity ratio of 432.5. That's a massive leverage burden. Their PE ratio is also relatively high at 36, suggesting a lot of future growth is already priced in. And despite some upward movement, the stock is still significantly below its 52-week high, indicating substantial volatility. Given these financial risk factors, Oracle continues its previous rating.
Our take on Oracle, ORCL, today is stay away.
Moving on, we have Open Door Technologies, OPEN. There were a couple of big posts about huge bets on this one, with one user even calling it a YOLO play.
And let's not forget the insider buying here, Brooke. Over 92 million shares net purchased by insiders in the last 6 months. That's a massive show of confidence from those closest to the company, suggesting they see a significant turnaround ahead, despite current numbers.
Ethan, that insider buying is a strong countersignal, I'll grant you, but the community sentiment itself is overwhelmingly skeptical. Users are calling it a gamble and a meme stock, directly criticizing its lack of profitability and its business model. And the KPIs back them up. Negative net profit margin, negative EPS, a staggering 220 debt-to-equity ratio, and revenue growth that's actually negative at 33.6%. The company simply isn't making money. This stock has been a consistent stay away in our previous ratings for good reason.
For Open Door Technologies, OPEN, our analysis suggests stay away.
Next up is Netflix, NFLX. The latest buzz is around the intensified bidding war for Warner Brothers Discovery.
Well, you know, Jefferies recently affirmed a buy rating on NFLX, partly due to those acquisition prospects. There's also a potential win-win scenario where if the deal falls through, Netflix could get a hefty breakup fee and avoid integrating some of those linear assets. That's a clever strategic play, aiming to expand their content library.
But Ethan, the immediate market reaction was negative, with the stock falling after the news. Users are bearish, with some commenting that Netflix goes down lol, regardless of the situation. The PE ratio is still high at 39.34, implying significant growth expectations that are now clouded by this bidding uncertainty and potential antitrust scrutiny. It's trading far below its 52-week high, and with a high beta, it's prone to big swings. This one has consistently been a stay away for us recently.
So for Netflix, NFLX, our market commentary today is stay away.
Following that, we have Paramount Skydance Corporation, PSKY, involved in that same bidding saga for Warner Brothers Discovery.
The big news is Larry Ellison personally guaranteeing $40.4 billion for Paramount's bid. That's a game changer, addressing previous concerns about their capitalization. Plus, there's been significant insider purchasing activity, which screams confidence in their future strategy.
Ethan, despite Ellison's backing, the community sentiment is overwhelmingly bearish. Users are highly skeptical of acquiring legacy media and fear PSKY will be saddled with debt. Our KPIs confirm this: an astronomical PE ratio of 453.66, negative revenue growth, and a deeply negative net profit margin. Their debt-to-equity ratio is also sky-high at 111. While insiders are buying, the underlying financial picture for PSKY is quite dire, relying entirely on a highly speculative and risky acquisition. This rating is consistent with our previous stay-away assessments.
For Paramount Skydance Corporation, PSKY, our analysis is stay away.
Next, let's talk about Novo Nordisk, NVO. This one had some very mixed signals today.
This is exciting, Brooke. We had reports that the FDA approved the first GLP-1 pill for obesity from Novo Nordisk. Their stock jumped 8% after hours on that news, with users anticipating even bigger gains. They have excellent profitability metrics, a PE of just 13.14, and the stock is trading near its 52-week low. This oral option could be a huge market opener.
Well, Ethan, while the news is indeed significant, the user sentiment is surprisingly bearish despite it. Many are frustrated with past losses, with one user saying, "I'm minus 52%, and another lamenting the stock will somehow find a way to end red tomorrow. There are real concerns about scaling production for the oral drug, which could impact profit margins, and strong competition from Eli Lilly. The stock has been consistently underperforming, and this latest news just hasn't generated the sustained enthusiasm to offset that. It's a classic case of good news already priced in, or simply not enough to turn the tide of investor frustration. We've rated it both buy and stay away in the past, but the current investor experience is a red flag.
That's a tough pill to swallow, Brooke. So for Novo Nordisk, NVO, considering that strong underlying user dissatisfaction and scaling concerns, we're going with stay away.
All right, let's lighten the mood a bit with Amazon, AMSN.
Now, this is a clear winner. User sentiment is explicitly bullish, with talk of AWS reacceleration driven by AI demand, a resilient consumer, and strong Q4 results expected. Analysts are projecting a 30% surge. Amazon has robust revenue growth at 13.4% and an impressive return on equity of 24.3%. Even though there's some minor insider selling, the overall outlook is overwhelmingly positive, consistent with previous buy ratings.
Ethan, the KPIs are indeed solid for Amazon. A PE of 32.17, while high, is pretty typical for a tech giant with its growth prospects. The strong ROE demonstrates efficient management. The only real caution is the insider selling, though it's relatively minor in scale. The bullish sentiment and news seem well aligned with its growth trajectory.
So, our AI-generated insights suggest for Amazon, AMZN, buy.
Moving to Palantir Technologies, PLTR.
This is a fascinating one. We saw a post from a user who made over $2 million profit from PLTR, calling it a moonshot that worked. That really speaks to its growth potential. Plus, William O'Neill just initiated a buy rating, and it's being called a no-brainer AI stock to buy. The company has incredible revenue growth at 62.8%.
That past profit is impressive, Ethan, but the user sold their position and is now diversifying into safer assets. That's a key detail. Our KPIs show an extremely high PE of 451.12 and a P/B of 70.16. These numbers mean a staggering amount of future growth is already baked into the current price. Any slowdown, and this stock could see a significant correction. Insider selling here also slightly outweighs purchases, which is another cautionary signal. We've consistently rated this as stay away in recent times.
For Palantir Technologies, PLTR, our market commentary suggests stay away.
Next up, Intuitive Machines, LUNR. This stock always generates some strong opinions.
Oh, LUNR is definitely a pure gamble play, as one user put it, but with potential for huge rewards. We're talking 800% gains for some, driven by anticipation of massive NASA contracts, like a potential $4.6 billion LTV deal and a $5 billion SATSCOM contract. There's real belief it could be a $20 billion company soon, despite past lander issues. Plus, insiders have been buying, which is a vote of confidence in these future prospects.
Ethan, this is where the gambling part comes into sharp focus. Our KPI shows severe financial distress, negative revenue growth, deeply negative net profit margins, and a truly concerning negative price-to-book ratio, meaning liabilities exceed assets. The debt to equity is an alarming 152. These are fundamental red flags.
While insider buying is positive and the potential future contracts are enormous, the current financials are just too weak for anything but the highest risk appetite. It has often been a stay away in our past.
You're right, Brooke. It's certainly high risk, but the community optimism is palpable. So for Intuitive Machines, LUNR, our analysis suggests speculative gamble.
Then we have Tesla, TSLA.
An interesting one today. One user called selling TSLA for RKLB their second best investment decision. But the news is full of bullish reports. Tesla stock poised for even more record highs, and shares jump after court reinstates Elon Musk pay deal. That positive sentiment around Musk and the company's innovation keeps driving it.
Even that investor's decision to sell Tesla is a telling point here. Tesla's valuation metrics are incredibly stretched, a PE ratio of 332.47 and a P/B of 20.31. This implies a market expecting perfection and sustained hypergrowth. Their debt to equity is also very high at 17.08. While recent news might give it a bump, these KPIs indicate an extreme overvaluation that leaves little to no room for error. This stock has consistently been a stay away in our recent ratings.
For Tesla, TSLA, our market commentary is stay away.
And finally, let's dive into Rocket Lab, RKLB. This one has seen a tremendous amount of community chatter.
And for good reason, Brooke. Community sentiment is overwhelmingly bullish, with users declaring diamond hands, talking about 100 plus next year, and calling it a forever stock. They're impressed by the $816 million deal, massive backlog, and future projects like the Neutron rocket. One user even called it the second best investment decision made. Rocket Lab is clearly seen as a future leader in space. We even had a buy rating for it yesterday.
Ethan, I know the hype is strong, but despite that user optimism and all the positive news about deals, Rocket Lab's financial reality is still challenging for new investors. It's currently operating at a significant loss, with negative net profit margins and negative EPS. Its price-to-book ratio is an extremely high 30.05, meaning much of that ambitious future is already priced into the stock. And critically, insiders have been net sellers of over 6 million shares in the last 6 months. That's a significant amount. While previous AI-generated insights might have seen short-term potential, for today, with the stock near its 52-week high, current financials and insider activity suggest caution. That insider selling is a real head-scratcher, especially with all the positive news. So for Rocket Lab, RKLB, despite the incredible community optimism, our analysis for new entry points suggests stay away. All right, that was quite the ride today, Ethan. Let's recap our AI-generated insights for today's deeper analysis.
Definitely, Brooke. After sifting through all that data and community discussion, here's where we stand for today's top candidates. Investigate as buy, Amazon.com, AMZN. Investigate as cautious buy, none. Investigate as speculative gamble, Intuitive Machines, LUNR.
And that wraps up another episode of the Daily Hunt for Multibaggers.
Just a friendly reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for tuning in.
We'll catch you next time on The Daily Hunt.